You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everybody. Welcome to this episode of the Capital Table. Thanks for joining us. We have a private credit symposium coming up through the Earnout magazine, and excited today to talk about the topic of private credit with our great friends, Drew Brantley and Paul Marino. I'll let two of you briefly introduce yourself and your firms, and then we'll just dive into the topic. So, Drew, we'll start with you.
Great. Thanks, Steve. Appreciate it. Excited to be here today. I'm Drew Brantley with Frisch Capital Partners. We're a boutique investment bank. We're based out of Georgia, but we work across the country. And we specialize in helping raise equity and debt for independent sponsor transactions, anywhere from kind of 3 to 20 million of EBITDA. So we're really kind of squarely in the lower middle market or the lower part of the middle market. But yeah, we're excited to be here today. Thanks, Steve.
Thanks, Drew. Paul?
Steve, thanks for having me again. I love being on here with you. You're such a good friend, and I'm excited to be here with my other very good friend, Drew Brantley. Both you guys are excellent in your respective fields, especially in the middle market. Paul Marino, I run our corporate and M&A group at Sadis and Goldberg. We are a middle market law firm specializing in middle market and lower middle market transactions. We provide superlative service at a fair price. And again, Steve, thank you again for having us.
Yep, pleasure to have you both here to talk about this topic, which again, we're going to dive into in a symposium coming up. Private credit's been one of the fastest growing segments in the alternate investment market. A lot of that has happened really accelerated since the global financial crisis. But, again, reason we're having this symposium is because of how important this has become in the world of middle market M&A. Drew, let's start with you, what you've seen drive that growth over time.
It's a good question. I think there's kind of two perspectives, from the LP perspective and then also from the borrower's perspective. From the LP's perspective, I think if you look, there's more and more private capital in the markets today than ever before. I don't know the numbers today, but it's staggering. And a lot of that capital that's out there seeking yield and current return, and private credit's a great opportunity for that. A lot, and depending on where you are in the market, anywhere from kind of mid-single digits, up to low double digits from an interest rate perspective is a nice yield for a lot of people. And then from a borrower perspective, I think private credit provides flexibility that traditional senior lenders haven't always had the ability to afford to their borrowers, given some of their regulatory compliance, needs. So from a borrower perspective, a lot of, whether it's independent sponsors or private equity or companies directly, private credit just lends to a lot of flexibility, whether it's being interest only with a bullet payment in year 5, so less of a cash burden on the business and no amortization, or, no or one covenant situations for borrowers. It just provides flexibility. And I think that's why a lot of borrowers are gravitating towards private credit these days.
Absolutely makes sense. So, Paul, what would you add to that in terms of the reasons behind this growth in private credit and important to the market?
All of Drew's points are 100%, as you would expect, on target. I would say that, since the GFC, the regulatory body has pushed commercial banking out of the middle market and lower middle market. And as they've squeezed commercial banking more and more out of it, the market has reacted as it should. And, the highest, and best and efficient use of capital is flowing into private credit. And whether that's direct private credit in a unitranche that's, ABL or some type of asset base with a mezz piece or SBIC, et cetera, it's really filled that gap nicely. And, the funny thing about it is that, you guys both know this to be true. The funny thing about it is that big commercial banks backstop a lot of these private credit funds with warehouse lines. So irrespective of whether the Fed wants them out of the space. They're in the space, and now they're not even now it's not even regulated like that. So it's like to me, it's almost comical, like anything else that, that government gets into, they just don't understand. With that being said, I think that the private credit provides a lot of flexibility, like Drew said, in the space, and it's going to continue to grow.
Yeah, and I think those are all great points, and I'll add to that. And Paul, you just touched on it a second ago that really started post 2008. A lot of regulations forced banks into doing what they needed to do in the middle market. Private credit comes up, and and I think that's one of the appeals why a lot of people have started private credit funds and put their efforts behind this, is because there is less regulation. So kind of the flip side of what you were talking about, and that certainly has led to its growth. And and I think Drew said it well in terms of there's investor reasons, there's borrower reasons, and it certainly has made it easier to get a lot of middle market deals done. Let's talk about one segment of private credit, or one part of the capital stack, in looking at senior debt, which pre-2008 certainly was dominating middle market M&A, obviously still relevant, but was dominating, and subordinated debt. Let's compare those two types of vehicles. I mean, if Paul, would start with you. If you look at the advantages of senior or disadvantages of senior as compared to subordinated debt.
Sure. So, I mean, seniors, that's basically the top of your cap table. They're fully secured, depending upon what you're doing or otherwise, right? I mean, if you're in a, certain asset classes, the only way you can secure it is if you actually take possession of it. But, assuming most middle market PE or independent sponsors, they have the asset, and it's basically a UCC1. So, you have, for all intent and purpose, you'll have negative covenants in those transactions, and with a UCC1, which I wouldn't say handcuffs you, but certainly limits you how much you can borrow, where a mezz lender will sit second, but it's usually more expensive money. A lot of it is dependent upon the business. It's no one size fits all as it relates to debt. I mean, we've had clients in the past that, if a commercial banker came in and they looked at their balance sheet, they might puke on the loan, but the truth of the matter is that they throw off so much cash flow that they can support the loan and keep growing. And in that situation, you need somebody with a lot of not only industry expertise or smarts, but you need, folks who understand the lending space, which is, by the way, as an aside, an interesting thing, because, banks like LaSalle Bank out of Chicago used to have guys who really understood credit and really understood how to underwrite and then track and follow. And that's my biggest concern. I don't want to also sidetrack, but my biggest concern with credit and private credit funds is that they don't have enough fully formed, credit adults, if you will, that really understand the space, and that's really where I think they go awry. But nonetheless, the difference between the two is really flexibility. Where mezz, you may get more flexibility. In a first position lender, you likely get less.
Well, and I think one of the other advantages to senior debt in the minds of many middle market business owners is, my interest rate's going to be smaller, and I want the lowest rate possible, and some of them get fixated on where can I get the lowest interest rate. But with Drew, your thoughts, and Paul kind of touched on this a little bit, but how does someone go about looking at what is the right lender for my M&A deal? Or maybe said differently, other than measuring the interest rate, which is easy, there's a lot of other important factors when you're trying to decide, looking up and down that capital stack, which direction should I go?
Yeah, look, it's a great point. And you actually took the words right out of my mouth, Steve, because people oftentimes ask us, they get very myopically focused on interest rate. And they're like, well, what's the interest rate? And it's all about interest rate. And in our experience and opinion, interest rate's one of the things that you should look at. But first, we've got to start with the deal. Like, what's your thesis? What kind of company you're buying? To Paul's point, what's the cash flow of the business itself? How consistent and steady is it? Is there any cyclicality to it? There's a lot of factors that go into looking at the business itself, and then thinking about, okay, once we understand the business, what type of lender or what type of debt, if we're looking for some debt on the business, do we think is going to be appropriate or the right partner for the business? And there's a lot of flavors that can come in. So yeah, interest rate's one of the things, but that's like honestly one of the last things that we look at. If you're doing, for example, a buy and build, if you're a lower middle market or an independent sponsor or a middle market private equity firm, and you're trying to do a buy and build in a fragmented industry, and you're going to be aggressive on the buy and builds, or if you want to do organic growth within the business and it's going to take some time to ramp on that investment, you have the potential to bust some covenants by growing quickly in there. So a senior lender that has the cheapest interest rate is not necessarily always going to be the best partner for your thesis, just as an example. And so what we try to do is we try to look at like the whole deal and say the gestalt of the deal and say, who do we think is not only going to be interested in this, but who do we also think is going to be a good partner for this particular deal? And look, there's plenty of deals that I think, yes, traditional, equity investor with a senior lender on top with the cheapest debt, because you're going kind of low to moderate leverage, between 1 and 2.5 turns of leverage on a business. Senior debt can be great for that business all day long. But keep in mind, senior debt, to Paul's point, it's going to have tighter covenants. It's also going to be amortizing. So the cash burden potentially is going to be higher on the business. And so if you look at it on a cash burden of the business, not just on the interest rate with the amortization, that's where you can look at potentially some of these private credit funds that are out there that might be unitranche lenders, or either might do like a strip of mezz and then a strip of mezzanine, basically unitranche within it, but they'll do kind of two different strips within it. But, so your average cost of capital all in can be the same or less than what a senior bank can have with amortization, because the private credit might have no or low amortization. So with that lower cash burden on the business, to what we talked about earlier, it just gives more flexibility. I'm not pushing that that's the way to go, but I'm just trying to highlight that as a borrower, it's not just about the interest rate, Steve, to what you said. And so many people start with that and they're like, well, how much is it going to cost me? What's the interest rate? And I'm like, well, let's talk about that in a minute. What are you trying to do? And then who do we think might be the right partner? And then let's talk about that. So
yeah, you got to think about it, right, Drew? At the end of the day, what really is expensive money? Like if I'm growing an enterprise business, right, or if I'm looking to grow enterprise value, right, and get real top line value because I want to sell this company, is paying a little bit more cash on cash more expensive, or is giving away equity or some type of warrant coverage more expensive, right? Exactly. And you have to make that decision.
Oh, totally. Look, if you can only get 2.5 turns from a senior lender, but they're the cheapest debt out there, maybe they stretch to 3 times. But with, a private credit fund or an SBIC or somebody like that, they can stretch to 3.5 and 4 times. Yeah, if you just look at the equity dollars needed, that can be so much more valuable to you. Now, look, I'll be honest, you have to perform as a business. I've seen the knife cut both ways here. Both sides of this knife blade are sharp. If it works well, it can really work well, to our point, and you can make a lot of money doing it on the equity side. But if it doesn't work well, you can be hamstrung and you got to slow down your growth. But if you don't perform, it doesn't matter what lender you have, you're not going to be able to grow the way you want to grow. Yeah, so you do have to perform. I think that's the important thing I'm trying to make.
Yeah, and I think you've touched on several important points on this topic. Flexibility, Drew, you were talking about relationship, and I think you can also weave into that, to your points, the industry experience and understanding of the lender and who the private credit lender is in that example, because to your point, things don't always go well, and you want a lender, you use the word partner, some of them would or wouldn't use that word, but, to be able to have someone who's going to be with you there in the hard times. And certainly one of the roundtable discussions we're going to have in our symposium talk, from the vantage point of a restructuring firm. So, I think any other kind of key things, Paul, from your perspective?
Go ahead, Drew.
Yeah, one other thing I'd just add that we didn't touch on, when we talk about partnership and alignment, some of these private credit funds as well are in the equity as well with you. So they're equity co-investor anywhere from a small amount to a larger amount, or even a majority of the equity, depending on the group. People often will say, well, oh my gosh, they're in the equity, they're going to be loan to own, they're going to try to take the business from me. And look, if that's somebody's MO, they're not going to be in business long these days because word spreads fast. That word's going to get around. Nobody's going to want to do business with them. And so most of these people, if they're doing that, they're really just looking to juice their returns. They want that equity kicker so that they can increase that return to their LP investors. And equity is a great way to do that because they're going to be limited by the interest rate that they can charge on the debt itself. But for you as a borrower, that can actually create a ton of alignment with your lender because if you were to hit a bump in the road or when you have an issue with the business, I'm not saying you bust a covenant, but every businesses have issues along the way. When you have one, if they're in the equity with you, it does create an opportunity for them to be more flexible than somebody that's just a senior lender whose, their flexibility for risk is about this much. And they have no flexibility to be able to work with you when you hit a bump in the road, where somebody that's in the equity can say, hey, we'll waive a covenant, hey, let's work with you. We'll pick the interest, whatever it might be. And we've seen all those things happen.
Yeah, and I think, those dual capacity lenders, those that can take on both sides, and you said it, but really to emphasize, it can align the interests with the borrower, the company, and the management teams in a much greater way many times. I mean, so Paul, talking about that SBIC funds and others who do both debt and equity, are you seeing that more prevalent in the lower part of the middle market, the middle market? Is there a certain point at which it's a better option or not a better option from your viewpoint?
Well, gee, I'll tell you, unitranche has been around for a long time. So, and it's, it's up and down the capital stack. And is it good or bad? It really depends upon the lender. A lot of it is really, and especially if the lender knows your space and you're comfortable in it. And, certain lenders, have a, certain lenders get skittish or they're looking for, small defaults, and other lenders are much more friendly and they understand, to Drew's point, that people do trip covenants and they're not going to be all over you. The fact of the matter is that good lenders, and if I was interviewing a lender, I would always ask how much repeat business they have and then speak to the clients, because good lenders have a lot of repeat business and they should, because the cost of capital is way lower. So, to me, to answer your question, yeah, unitranche is a great way to do it. The mezz piece juices up the senior piece 100%, and cash on cash for a lender, it makes sense. But again, as counsel, to an issuer, or counsel sometimes to, often to SBIC funds or what have you, the expertise of the lender in the particular space or vertical that they're lending into is very important. And, and whether they're unitranche or single piece or mezz or, or what have you, it's really their understanding of it, and they understand how to do it. For example, we had a client that was in the for-profit education space, and, their balance sheet does not look great until really this time of year, because all the orders start rolling through for books and things like that. And you'd have to have a lender really understand that. Because if they looked at it in a vacuum, they would just see it. They would see it super chunky.
Yep. I want to add one thing to kind of a lot of the points you guys were making, and how private credit lenders can stand out to a potential borrower. Certainly to add certainty of close. I've sat in management meetings with lenders and private equity firms, and certainly, especially they would say, as compared to a commercial lender and credit committees, that a lot of the private credit lenders have a much more efficient process and an ability to get deals done, which obviously, hopefully, as we're seeing, the M&A market pick up, we'll get back to the days where that speed to close and trying to beat your competitor to get a deal done and having the right lender at the table will matter. So without predicting the M&A market, Drew, we'll start with you. Where do you see the private credit market going in the next 3 to 5 years?
I think it's here to stay, and I think it's strong and continuing to grow. It is getting more competitive for private credit funds. So I think it's becoming more competitive from that perspective, but I think it's here to stay, and I think borrowers like the dynamics around it.
Paul, your thoughts?
Private credit's going to continue to grow. It will, in the middle market at least, surpass probably commercial in the middle market, commercial lending. and it's just a more efficient use of capital for private credit, and it's more efficient use of capital for commercial lenders. Like I said, they'll push warehouse lines into private credit funds, and it's a better use because they don't have the personnel. They, being commercial banks, don't have the personnel to deal with the middle market, lower middle market borrower.
And I think what's going to be interesting too, just given the economy and, the fact that we've been through some interesting times and low defaults is my real point. We're starting to see a little bit more on the default side, but it'll be interesting how the market reacts with, the default rate will likely go up on the private credit side, certainly, across the credit stack. So that's not specific to private credit funds, but that's going to be an interesting response. I think going back to what you said earlier, Drew, investors have loved this segment because default rates have been low, yields are higher, provided some great returns. And again, I'm by no means bringing this up as a doomsday sort of prediction, but it's going to be a factor in the market. And, I think another thing I was reading that certainly, commercial banks need to continue to kind of get a lot of these credit off their balance sheet due to a number of factors regulatory wise. So it's going to continue to go in that direction from a commercial lender standpoint. So somebody's got to pick up the slack. And then, I think, another kind of macro thing that's real interesting is the big banks, private equity funds, others who have teamed up and have formed private credit funds. I mean, Paul, you obviously said this earlier, and again, emphasizing that as I think a really important macro trend that's going on out there. So, well, I look forward to talking about this and more, at our symposium. Gentlemen, and Paul, I don't know if you have any final thoughts on private credit.
One of the things we thought about when we put together for the earnout, and again, the whole idea of it is for education first. And one of the things we really thought about is to talk to sponsors and participants in the conference is really to educate them on the different types of private credit. And just to give you one simple kind of thought process on that glide path is, a lot of SBIC funds will have warrants in their lending package, and borrowers will get heartburn when they look at it, but it's really just a means to ensure that, the loan gets paid off at a certain period of time or they get paid out, a little bit extra juice. And without that education, you may turn away from a very good lending product because you just don't understand it. So, again, that was our thought process. The three of us, when we thought about, hey, let's do this earnout conference, our thought process is, let's educate a lot of sponsors on the different types of lending products out there so they have a better understanding of it.
Yeah, absolutely. Drew, final thoughts from you.
Look, if you're not stuck, come join us. Not only is it a good day with some good education, but also 12 one-on-one meetings, but we're going to go to a Cubs game. So come join us. And that's included in the registration. So it'll be a good time.
Yep, we're looking forward to it. And for our audience, you need to learn more about it. Obviously, reach out to one of us, but look forward to seeing these two guys as well as our registrants and attendees at the conference. And if you missed it, well, you can catch up later. But thanks for joining this episode of the Capital Table, everybody. Look forward to talking to everybody again soon. Thanks.
You've been listening to the Capital Table. For more information, please visit withum.com. Thank you for listening.